significant role. My sense is that retail investor didn't pump in that much money. My sense is that even last year, while we saw the index going up from 2,800 to 5,300, the retail investor has still been suspicious and fearful. Not all people, but many, which is sad. But institutional liquidity has been driving this market. And my sense is, for the next 12 months, institutional liquidity on the demand side would still be a positive factor. It would not be something that would remain a question mark while we take decisions about the market. The other point about liquidity, there are two other points about liquidity, it's so important we have to talk about them, are requirement of liquidity, the supply of paper. This portion of the market has not been given, in my view, enough importance by analysts. But you're seeing it. We saw a huge supply of paper by, in the Indian context, by NTPC and REC in February. The market didn't accept that. Retail investors were not happy about the price, while they flocked to mid-cap IPOs where they liked the price. Clearly, the market was voting with its feet. But the large investors took money away to invest in these issues. So the liquidity got sucked out. And this is a phenomenon we have to worry about. There's another interesting point which I don't know if it has occurred to you. We talk about, what, 80,000 crores or so of FII investment that came into India in 2009. A very large portion of that came through QIPs. Maybe 50 to 60,000 crores. When the FIIs found Indian valuations very exciting, and when Indian companies found that their balance sheets had got mauled up due to the financial crisis, the first temptation was to privately place capital. And these are the QIPs. Now, the QIP is a world by itself. You need to study it. And to my mind, a QIP is a market negative factor. What does the QIP do? It takes away the liquidity, which was otherwise meant for the secondary market, creates paper, which later comes back as secondary market on the sell side. This is what we are seeing in 2009. And one needs to study what is the impact of that and what's the linkage between QIP issuance and the market indices. To my mind, the issue of QIPs by Indian private sector will dwindle away now, purely because of the valuation argument. If I was an FII and I was getting a lovely Indian paper at 11 PE, I'll buy it. If I'm getting the same thing at 24 PE, why would I buy it? If I had something, I'll sell it, right? So to that extent, on the supply of paper side, which is very important to look at when you do a theory on market liquidity, the supply from the government companies is going to increase like anything. We saw NMDC, that issue also bombed with retail investors, and we don't know what all are going to come. Hindustan Copper is going to come. Many companies are going to come. That's going to suck away liquidity, probably institutional liquidity, but we may have less issuance of private paper by Indian companies. But liquidity is a question mark. We are played by the ear. The other thing, my view about liquidity also, it follows valuations. Liquidity is not an independent variable. It's a bit like, let's say, water is flowing. Liquidity is often compared to water. Water is flowing. There are 4 holes. Where will the water settle? Where the hole is empty. If the hole is full of some fluid, it will go over that. So if the valuation is nice, that means the hole is empty, it will go and park itself. On the other hand, if it's overvalued, instead of the water going down, the water from the hole will go out. Right? So when you talk about liquidity, you'll have to talk in terms of valuations and fear, risk aversion as we call it. So in this broad picture, liquidity would be positive, but one has to be very mindful as an analyst of the outflow of liquidity, which can cause jerks in the market, whenever there are big IPO issues or big money being taken out. Last piece is you buy stocks. So that means, what are the valuations like? This is a $1 million argument. Each one of us will have our view on the argument, and some of my best friends in the analyst community, and I have violent arguments on it. Let me give my piece on that. This market is right now, to my mind, fully valued. On the basis of the evidence we have as of Q3 results of the Indian corporate sector, it's very tough to make a valuation buy in the top stocks. That's a fact. Then why do we still buy top stocks? Because many of us feel that the Indian market and the Indian top companies which represent the cream of the Indian market or the Indian economy would be doing extremely well in 2010-11. And that would translate into an across-the-board re-rating of corporate earnings through 2010-11. The re-rating surely will be sectoral. Not all earnings will be re-rated, but a substantial number of them would be re-rated enough for us to make a rather bold statement that if one looked at a top-down call on the earnings per share of the index based on one's reading of the Indian economy, the growth in companies, their debt levels, their cost of capital levels, etc., one would probably talk about an EPS for the index of upwards of 1,000 going forward. And only that's where the Q4 results are going to be very important. How much upwards of 1,000 is a moot point. And that should drive stock prices. So on valuations, my view is in the immediate, the valuations do not look enticing in the large stocks. But clearly, if one takes the viewpoint that the strength in the economy as shown by a 7.2 GDP growth going up to probably 8.5, driven by manufacturing growth probably at almost double digit and service at about 11.5%, we could look for a 15% upgrade in earnings going into 10-11 in many sectors, because the debt level will come down, the margins would go up.